Intercompany transfer of assets. Upstream sale of depreciable assets, equipment, beyond year 2. In this example, we're going to look at the equity method and consolidation accounting entries that take place beyond the 2nd year. We'll go to X10. And just a point here, we'll always make the income entry, the dividend entry, and we'll continue to make the entry for the excess depreciation for $6,000 until the asset is sold at some point in the future. For consolidation purposes, we'll make the following entries as well. This is going to be the first one. Entry is to allocate, to eliminate the equity method entry, and then to assign the NCI their portion of the excess depreciation. The second EJE is to establish the equipment at its correct value and to record the deferred loss that occurred from the first year. What we also see is the excess depreciation entries that we have for X7, 8, 9, and which is what we did similar to the downstream transaction. So we allocated those out between the investment and the NCI for each year, and we can denote or know which is the current year entry, which is X10, the very last one, because it's going to depreciation expense. X7, 8, 9 represents prior entries there, so we know, if we were to just glance at those, we should know what that is. Let's move on to selling the equipment, and this takes place on January the 1st of X11. Notice that the sale takes place at the beginning of the year, so the parent will not depreciate the asset at all for X11. We need to compute if there's any gain or loss, and we see that we take the parent's cost less their accumulated depreciation, and we get a gain of $120,000. So the parent will have a $120,000 gain on their financial statements, which will carry forward and be included in the consolidated number. What remains, though, is the gain or loss computation for the deferred gain, or sorry, the deferred loss. The original loss was $52,500. And what we've done is we've amortized or recognized some of that loss over X7, 8, 9, and 10. We've recognized $30,000 of that. So what's happened is $22,500 of the loss has not been recognized yet. So what we can do is during the current year, we can recognize that loss on our consolidated financial statements. So under the equity method of accounting, we will recognize this loss immediately. And what we'll do is we'll debit income from subsidiary, which is going to be an expense or a reduction in income, for $22,500 times 80%, our ownership percentage. And that takes care of the loss for 2011. We can now do the consolidation accounting for 2011. The first thing we'll do is address any equity method entries we may have. And the only equity method entry that we have this year is the recognition of the unrealized loss of $18,000. And remember, during the allocation process, when we eliminate this equity method entry, we must also assign the NCI their portion of the loss at this time. So we're going to do the following. We're going to credit income from sub, credit income to NCI for their value, their portion of the loss, and we'll debit the investment sub and NCI. This leads us to the unrealized gain or loss that exists or remains. So let's recap what we have here. We've got two entries here. The first is to establish the equipment to its correct value, to record the deferred loss originally, and to establish the accumulated depreciation. And in X11 we've got the following entry 4 times. And this represents the excess depreciation for years 7, 8, 9, and 10. Remember, we're in 2011. We could shorten this up a little bit if we consolidated those 2 entries. And we could combine the like accounts. And if we did, we'd get the following. You see the computations here below the journal entry to get to the values that we need. The 24,000 represents the excess depreciation for the investment sub, the 1,500, the 6,000, the NCI values, and the 7,500 is the depreciation amount. We can combine all those together and get the following entry, and this would be one entry we can make on our EJEs, or we could combine them or separate them out like this for one entry. Doesn't matter to me what you do. And what this leaves us with is the following. If we take this entry, we ask ourselves, is the equipment still here? In X11, the equipment was sold. And it was sold at a gain. So, but all this tells us here is that we're able to recognize any deferred gain or loss that existed. In this case, we see that it is a deferred loss that we have. So what we're going to do is we're going to reclassify the 2 items, the equipment and the accumulated depreciation, to deferred loss account. And for now, we're splitting them out. And if we combine them together, we're going to get a debit to loss on sale. And if you go back to the unamortized loss, that does agree to that. That's the 22.5 there. So we would make one entry in 2011 to record the recognition of the deferred loss. And if we were to take everything that we've combined together and put it into a recap of everything for 2011, we'd get the following. The first entry represents the EJEs for the equity method accounting and the assignment to the NCI. And the last is a combination of the compound entries added together to get the recognition of the loss on the sale. And on the consolidated net income, since we have sold the equipment to an unrelated third party, any deferred gain or loss that was being postponed would now be recognized, and we see that as we would recognize the unrealized loss that exists when we do the consolidated net income.